Financial Argument channel and subscribe to it. In order to support us, please do not forget to like our videos and comment on it with your own views. Finally, you can visit our website address, financialargument.net, and social media accounts for more financial news.
This video posted with permission. The financial and political opinions expressed in this video are not necessarily of Financial Argument or its staff. Opinions expressed in this video do not constitute personalized investment advice and should not be relied on for making investment decisions.
Full confession time. I never, and I mean never, thought that the world of financial and monetary recklessness would carry on this far or this long. Here we are, a full 10 years into an endless sea of money printing, and only now are the world's central banks considering ending money printing. Yes, the U.S. Federal Reserve is slowly unwinding its balance sheet by allowing certain items to run off, but collectively, the world's major central banks have pumped $1.1 trillion into the markets in the past year. The result of all this money printing is now well known. Massively inflated real estate, stock, and bond bubbles, as well as extraordinary wealth and income gaps that are fueling vast political shifts in Europe and the U.S. Someday, all of this insanity ends. Someday, things get back to what we might call normal, but how? That's the question. Will it be orderly and polite, as the world's central banks and current politicians are hoping, or something more disorderly, if not irreparably damaging to the average investor's portfolio, and possibly even employment? So, we're going to dig deeper into the insanity with Wall Street expert, financial expert, president and founder of PENTO Portfolio Securities, and author of the book, The Coming Bond Market Collapse. Mr. Michael Pento last sat with us in 2016, and we're really pleased to have him back. You've probably seen him on all the major financial news networks, or maybe read his book, or invested in his portfolio. Michael, it's a real pleasure to have you back with us today.
And thank you for having me back on, Chris.
All right, Michael, you're on record as saying you think there will be another financial crisis. Recent article of yours. Take us through your thesis.
Oh, geez, it'll take me about an hour and a half to do that, but let's give you the Reader's Digest version.
All right.
Well, first of all, you touched on it in your opening comments. You said that the central banks printed over $1 trillion this year. Let me expound on that for a second. So since 2008, global central banks, since they want to repeal the business cycle and eliminate recessions forever, they took their balance sheets as a whole from $3 trillion to $15 trillion. Now, by my math, that's $12 trillion of money printing, or what I like to call as counterfeiting, to try to keep asset prices from collapsing. Well, they've done that. They've taken stock prices to a record high. We're now at 145% of GDP, so equity prices in the United States, their market cap, as a percentage of the economy is 145%. That's really never happened before. We're at an all-time record high there. It ties the previous record set in March of the year 2000, ominous time. The normal ratio there is 50% or so. So stock prices should be, the value of assets should be about 50% of the economy, the underlying overall economy. But they're 145% today. So we printed all this money, put stocks in a bubble. We've obviously put bonds in a bubble. There's trillions of dollars worth of negative yielding sovereign debt around the world. And of course, real estate is now back into a bubble too. So we have all these bubbles coming to a confluence together at the same time, extend together. And now central banks are tightening. Now, my personal opinion, Chris, and I'm sure people will argue with me, as they like to do, but my personal opinion is that the Federal Reserve is the most aggressively tightening, hawkish central bank that we have ever had. And I'll explain why.
Ever.
First of all, we all know the Fed has been raising rates. They've raised rates from 0% to 2%, and they're doing it now to the tune of about 4 times per annum. They're supposed to do it again in October, September, October. Supposed to do it again in December, so September and December. That would be 4 hikes this year. They're supposed to go a few times next year. But there's a little problem. Let me hold on. Let me just back up a second before I say what the problem is. They're also selling assets. They're also draining their balance sheet. Yeah, and I say selling because that's exactly what they have to do. See, when the Fed has a bond due, let's say they have a 10-year note that's due, and they want to destroy that money, they say, okay, Treasury, send me the principal. And the Treasury doesn't have any money, so the Treasury has to go to the public and raise money. Well, they have to do that to the tune of $50 billion per month come October. So now it's 30. It's going to go in July. It's going to go to 40 billion a month. That goes to 50 billion. That's $600 billion a year added to the public supply of treasuries that they have to actually finance at a market rate. That's on top of the $1.2 trillion deficits that we're going to have in fiscal 2019. So the Fed is about as tightening as they could ever, as hawkish as they could ever be and have ever been. But here's the problem: the spread between long-term rates and short-term rates is just about as narrow as it can be without being inverted. So right now, as we record this interview, the spread between the 2 and 10-year Treasury note is just 34 basis points. That means that when the Fed tightens rates in September, which they pretty much promised to do, because they're so deathly afraid of people working and being, gainfully employed, as if that caused inflation. Like, oh my God, the economy's overheating. We have to shut it down. So they raise rates again. That's 25 basis points. Assuming the 2 and 10, the 2-year note stays with that same spread above Fed funds, we're going to have a yield curve that's almost completely flat, and will be inverted when they go again in December. And why is that so important, Mr. Pento? Who cares about the yield curve? I'm sure someone's out there asking. Well, when the yield curve inverts, it almost always brings about a recession. In fact, I could say pretty succinctly that in modern times, in this fiat currency regime, given the conditions extant today, it will definitely cause a recession. And the reason is because these asset bubbles, the fuel for asset bubbles is monetary creation. It's a booming money supply, which we don't have anymore. And the reason why the money supply gets shut off when the yield curve inverts is because banks, their loans, are earning less than their liabilities, which are deposits. So when your assets are earning less than your liabilities, you don't make any more loans. You don't want any more assets. And you don't want to. That's a great way to make your bank insolvent. So what happens is that the money supply gets completely shut off because you're not going to make a loan against a deposit. You don't even want these deposits anymore. The deposits usually, by the way, when there's a recession and there's a withdrawal of asset prices, a contraction in those prices, usually get a run on the bank as well. So asset prices get dumped because there's a run on the bank, and these deposits get withdrawn. That's what usually causes, in fact, almost always causes a recession, and that's exactly where we're going to be come the fall and even closer towards the end of this year.
Michael, so many excellent points in there. You mentioned something I'd love to get your input on. You mentioned that the Federal Reserve and maybe the other central banks, they sought to replace the business cycle with, I guess we'll call it a credit cycle. So now instead of business failures, we end up with these credit market failures, which I'm going to argue, and I'm sure let me not put words in your mouth. They're an order of magnitude more harmful in the end than an ordinary business cycle recession where some bad business ideas get swept out. But when a credit bust happens, first, do you agree with that and analysis? And second, what happens you mentioned part of it with the falling money supply, but why are credit cycle disruptions so much worse than a business cycle disruption?
Well, if we had a gold standard, you have a normal business cycle, the recession is very mild because the primary point here is that asset prices never got so far overblown over their skis as compared to the underlying economy. Mm-hmm. But when you have negative yielding debt, so in other words, when you're a government or even in some cases in Europe, a corporation, and get paid to borrow money, this is a process that gets unwound very quickly, which causes bond yields to spike in dramatic fashion. Now, so far we have LIBOR that's gone from 0.3% to 2.33%. But you imagine the spike in LIBOR when that occurs. By the way, LIBOR, the London Interbank Offered Rate, is used to price 370 trillion, I didn't misspeak, trillion with a T, yep, dollars worth of loans and derivatives. You talk about a busting of the credit cycle. I mean, why in the world would you ever have $370 trillion worth of loans and derivatives outstanding when the actual debt outstanding of the economy, the entire global economy is a fraction of that size. And the debt outstanding is I believe it's $330 trillion. $230 trillion.
233 was the net last number I heard.
233 and
Yep.
330% of GDP.
Right.
So, $370 trillion worth of loans and derivatives. So when you have these bubbles that are created by a credit boom, you have housing that's distorted in price. You've got bonds that are distorted in price. And of course, you have, as I mentioned, equity markets, which are massively overpriced. People say, well, the market's fairly valued. I have to chuckle at that. When I look at median PE ratios, price to sales, and the market cap to GDP, this is the most expensive equity market ever.
So let's talk about the expense in the bond market for just a second, because I know you write about this, and I'm really keen on the insights we picked up from you in your book about the coming bond market collapse. So let's first, again, I said I never thought we'd be here, but Michael, what really astonishes me is that not only were we making mistakes, but we're making the same mistakes. They don't even rhyme.
No,
They're
worse.
the exact same ones.
Not the same, Chris. Not the same. The much worse mistakes.
All right, let's talk about one of those much worse
mistakes.
So you mentioned LIBOR, and so something that I think people need to understand is the difference between a corporate bond and a loan, because I want you to take us into the world of covenant-light loans, but help people understand why that's an issue.
Well, first of all, you have to understand that the quality of debt, so corporate debt as a percentage of GDP is at an all-time record high. It's just about 45% of the underlying economy.
Wow.
That's at a record high. But the quality of that debt, in other words, the number of zombie banks, zombie corporations, I guess that would mean zombie banks as well, but the number of zombie corporations is at a record high. In other words, what a zombie corporation is that the cash flow from operations does not match their liabilities as far as payment on debt service. So these are zombie corporations. And the number of triple B credit is also at a record high. So you have record corporate debt that exists in the context of the quality of that debt, which is at a record low. This is something we have never before seen. And that means when interest rates rise, and they are in the process of rising, central banks are, by the way, even Mario Draghi has vowed to end his quantitative easing program in October. It goes from 30 billion euros to 15 billion euros and then to zero by the end of the year. The Federal Reserve in October goes to $50 billion worth of reverse QE. So central banks are raising rates. LIBOR is spiking, as I've already indicated, from 0.3 to 2.33.
Wow.
So as these rates rise, that is going to put more and more stress on these marginal corporations, zombie corporations, and junk corporations that are merely existing by issuing debt to pay debt because they do not have the earnings to pay interest on outstanding debt. That has never before been the case. And that makes this next recession/depression so much worse because when we had the Great Recession of 2008, central banks had the ability to lower interest rates. Let's just take the Fed, for example. The Fed had interest rates at 5.25%, took interest rates to 0%, and began quantitative easing. Their balance sheet was about $800 billion in 2008, the end of 2007, beginning of 2008. However, now our central bank can only take rates from 2% to 0, and their balance sheet is at $4.4 trillion. And not only this, the government of the United States, their outstanding debt was $10 trillion in 2007, and now it's $22 trillion. So they don't have the wiggle room in their balance sheets anymore. But even worse, if you look at the European Central Bank and the Bank of Japan, the ECB is at 0, and the Bank of Japan is also at 0. Their Fed fund, their equivalent of the Fed funds rate is in minus territory, and their 10-year note is 0. The German Bund is 0.35%. And even worse, if you look at Mr. Kuroda at the head of the Bank of Japan, if the Japanese economy was to hit a recession, and by the way, they're halfway there because their Q1 GDP was minus 0.6%. So they're halfway to an official recession. What are they going to do, Chris? How can they extricate themselves from a recession when they're already at zero and below? And in the case of Japan, printing 80, well, I didn't say printing, let's say counterfeiting 80 trillion yen per annum. I don't make this up. I don't make these numbers up. This is why, thank God, I have a successful business, because I just look at the numbers, and the numbers tell me where to go. You have a central bank of a major world power, a major world economy. I believe they're number 4 on the planet. And they are printing, in order to stay afloat, to stay alive, 80 trillion yen each and every year to keep their bond market from imploding, to keep their equity market from imploding. And if they go into a recession, I guess all they have to do, Chris, is throw their hands up. Because what are they going to do? Lower rates? Are they going to start printing money? There's nothing they can do. And we're a globally linked economy. So when Japan goes down and the recession in the United States, and the recession manifests and metastasizes in China and in the United States, there's really nothing these global central banks can do, because all of their balance sheets are stressed beyond the limit.
Well, Michael, this is certainly an idea that is getting floated more frequently. People ask, and I think maybe rightly so, or at least forgivably so, hey, what's to stop them from just literally doing this all over again and just expanding their balance sheets by another factor of 3 or 5 or 10?
Well, I'll tell you why. I'll tell you why I think it's going to be very difficult. You see, when you have a fiat currency regime, it's all based on faith. See, if my dollars were backed by gold, I know gold has intrinsic value. It's very beautiful. It's extremely rare. It's virtually indestructible. And it's held its value, its purchasing power, for thousands of years. So it's not really based on faith. It's based on science. It takes about $1,000 an ounce of energy and effort to take an ounce of gold, for $1,000 to remove an ounce of gold from the earth. So I know it takes that much energy and effort. So I know it's got intrinsic value, gold. But when my currency is backed by nothing, it's only backed by the faith that central banks have the ability to control interest rates. In other words, you can print, the Federal Reserve, in the case in point, you can print money. You can print $85 billion a month for several years. You can take your balance sheet from $800 billion to $4.5 trillion at its apex. And you could only do that without having your currency collapse if 2 things are in place. Number one, everybody else is doing it at the same time. And most importantly, you understand, or at least the market has an understanding, that you, central bank, have the ability to sell those assets and drain that money supply, drain those excess reserves out of the banking system. And that gives me faith that my lousy fiat dollar will hold some semblance of its purchasing power. However, if you print $3.7 trillion and take interest rates from 5.25% to 0, and then just raise them a little bit, a couple hundred basis points, 2%, and then you say to me, I can never drain my balance sheet, because if the U.S. economy enters a recession, that was your question, if the global economy enters a recession, why can't they just go back to the money printing, which I'm sure they're going to do? But when they do that, the market, which is the real progenitor of inflation, the market's verdict on the value of your currency and the ability for it to maintain its purchasing power goes away, and it goes away to 0, and it goes away quickly. So when the Federal Reserve under Jerome Powell says we are lowering interest rates, we couldn't get any higher than to maybe 2.5. And when the Jerome Powell says we are going back into QE, the cat's out of the bag, as they say. the market will understand that the Federal Reserve has permanently monetized trillions of dollars worth of assets, of which it will never be able to sell. It will never be able to take those assets, those dollars, out of the banking system, and that's a recipe for runaway inflation, even if other central banks are doing the same thing. And that means that the big winner here is gold.
Well, I'm glad you came to that conclusion. I was going to get to gold eventually, but before we do, I have to follow this train of thought because it seems very important, which is, well, I hinted at it. Europe seems to be having, it has a more restive, more active population than the United States, for sure, or at least politically when it comes to issues. And the people of Europe have managed to figure out that it's a raw deal when your central bank prints money, throws it into, air quote time, the market, which is really the feasting trough for the big banks. And obviously it's very unfair because certain people just get enriched massively in that process. But when you look at people like the working people of Italy or Spain or Greece, etc., they really got the short end of that stick. So politically, I think it's going to be difficult for all the central banks to hold hands and sing Kumbaya this next time, because I don't think the ECB has the political firepower left. Maybe, I mean, Brussels seems pretty tone deaf, and maybe the ECB follows. But what's your thought on the idea that maybe Europe could be a fracture point in this coordinated global banking action we've been seeing?
Well, I said for a long time, by the way, those are great points you raised, Chris. I've said for a long time that in order for the removal of the stimulus to be successful, that all these central banks have to do it in coordinated fashion. It has to happen concurrently. So in other words, you couldn't have the Fed raising rates while the ECB didn't do that, and neither did the Bank of Japan. And what happens is the Fed is raising rates, and you see what's happening now in emerging markets. I mean, if you look at the Argentine peso and Brazilian real, what's happening in Poland and in Turkey, Turkish lira, these currencies are blowing up. So it's very, very difficult to unilaterally remove the stimulus. Now, you touched on a very good point. I want to just comment on it. This is the progenitor of the Trump administration. This is why he became president. And the reason is that the middle class of not only the United States, but in Europe has been decimated. It's been eviscerated, as a matter of fact. And what happens is when you follow this financialization model to prevent the business cycle and to eliminate it from ever occurring and to outlaw recessions from forever and ever, what happens is you get people in the very wealthy tier of the population. They become more wealthy because they own assets, they own stocks, they own bonds, and they own real estate. And what happens is you create inflation in energy and other things like food and clothing, and that's a much higher percentage in the weighting of the lower classes of their weighting of their monthly stipend, of their monthly payments structure. So what happened is you have a situation where the rich get richer and the poor get poorer, and it's that kind of stratification that is causing the five-star movement to come to power in Italy, and it would cause Trump to rise to the presidency. And I expect more of this populist movement to unfold as we get closer and closer to the inevitable, what I think would be unfortunately a global recession/depression, which I think is going to commence probably later this year.
You know, and I completely agree with that line of thinking. And just as a quick aside, Wall Street Journal just ran a very big, very nice, very sort of empathetic piece on Italy and focusing on these attractive young women who's still living with their parents and all that stuff. And they managed to get through a 1,800-word article and never mentioned the causative factor that you and I just discussed, which is central banks and how they've actually driven this wealth inequality and opportunity inequality wedge into society. How is it that we still have, I mean, just editorially, how is it that we're still subject to what I consider to be almost, if it's not fake news, it's really context free? How is this still possible here?
I think it's, well, the population has been numbed And it's very convenient to keep people as ignorant as possible as to the machinations behind what makes a currency valuable and the benevolence of having it backed by gold. It's to their advantage just to make sure people are kept ignorant. If they really knew what was happening with the purchasing power of their money, if they really understood the trenchant gap between the rich and the poor, they understand it viscerally, but they don't have it really explained to them. And that's why I come on programs like Peak Prosperity, because you're not going to watch CNBC. First of all, you're probably watching CNBC on mute if you're watching it at all. But if you take it off mute, you're not going to get a conversation like this. You're not going to get somebody, and I've been thrown off the channel for now over a year. And I don't even know why, but maybe it's because I come out and I call it what it is. I call the printing of $12 trillion by central banks counterfeiting. Mm-hmm. And I make people understand that these central banks can never take back this money. Because when you take back money, when you destroy dollars, as I was saying before about how the Fed has a treasury that came due, and they asked the Treasury for money. The Treasury has to float that to the public, and then the Treasury gives that money to the Fed, and the Fed burns it. They pretty much destroy it. They take it out of the system, and they destroy money. That raises interest rates. But when you raise interest rates on top of record asset bubbles and record debt, the economy collapses, just as it did in 2008. So that's where we're headed. But when you have central banks that maybe they are ignorant as well, perhaps, because they're looking at Phillips curve models to tell them what to do. So they're looking at the unemployment rate in the United States, sub 4% on the U3 metric. And they're saying, oh, my God, we're on the cusp of hyperinflation. We're on the cusp of a deflationary depression, not hyperinflation. It's quite the opposite. But they're looking at flawed models that have never worked, that are broken, and that have the data input is lagging. The inflation is a lagging indicator. So you have a central bank that's worried about growth overtaking the economy. What they really should be worried about is what happens when the economy collapses. What are we going to do? And why didn't we let the gales of creative destruction in 2009 allow asset prices to collapse to a point that they can be supported by the free market, and we can have a currency that's stable, and inflation deflation dynamic that's stable interest rates. We opted to get out of what would have been potentially a very short, truncated depression, maybe 2 years, but what we got instead was a decades-long recession. I mean, the economy never really grew. It grew at 2% or less, and that's only because you undercalculated inflation. So really had a decades-long wasted economy, just like they have in Japan, decades long. And that's leading up to this next step, which I believe is going to be much worse, a synchronized global depression. Unfortunately, that's what central banks and governments have heaped upon their populations.
And so I think this gets to a very, very good point, which I'd love to reinforce and maybe you could let me know if I've got this right or not. But CNBC et al., they're trying to tell us that the central banks are sort of this benevolent organization, and if they do their job right, we all win. But the truth is money printing is a zero-sum game. Some people win, other people lose. In the case of Japan, when they print to lower the value of the yen, they're like, yay, record profits for Sony. But you look at the people who are trying to live on fixed incomes or the people who live on imported food, and they're just getting killed. That is, the central banks transfer wealth away from everybody into the pockets of some corporations because, well, that makes sense to them. I'm sure they have reasons why that all makes sense, but they're redistributive organizations. I mean, Marxist at core, if ever there was a way to look at it like that. So your thesis would be that they can do this and they can pump these things up, but that they fail inevitably because it's not real prosperity. It's printed chimerical prosperity. And that when it fails, it fails rather suddenly or maybe even comprehensively.
Exactly right. I wouldn't call it a zero-sum game. I'd call it a negative-sum game because in the short term, you're going to have the evisceration of the middle class and the lower classes. Everybody becomes lower class. The middle class becomes lower class, and you have a plutocracy. You develop a very small aristocracy in the country, And then what happens is that's not even bad enough, because what happens at the other end of this credit cycle, when it blows, everybody becomes impoverished. And at the end of this next cycle, Chris,
Mm-hmm.
you thought the money printing was bad before. What's going to happen is, instead of just lowering interest rates and then going to quantitative easing, they're going to have to deploy new things, such as helicopter money, negative interest rates, and the banishment of cash to get inflation going. So I don't think just going from, well, in the United States, going from, say, 2.5 to 0, and then starting to print money. I mean, what I mean is just printing money and going through the primary dealers, giving them excess reserves, isn't going to be enough to turn around the economy. They're going to have to circumvent the banking system and send cash directly. In other words, the central bank is going to directly monetize Treasury debt and have the Treasury send it to their citizens. And also, they're going to banish cash. I think they're going to have to make cash illegal. That's why this whole BS about cryptocurrencies is being allowed to flourish for so long, because I believe, and I wrote about this now for well over a year, that central banks will adopt something I call like a Fed coin that's traded on the blockchain. So you'll have money in the bank that's electronic, and you will be unable to withdraw that money in physical cash. You cannot hoard your assets, because they're going to go to negative interest rates. In order to get the velocity of money to increase, in order to get the money supply to increase, they're going to have to go to negative interest rates. In other words, you're going to have a coin, a virtual coin in a bank worth, X amount of dollars, $1,000 worth of a Fed coin, and that will be diminished by 10% per annum in negative rates. So you'll have $900 at the end of the next year, and you can only withdraw that money to spend it. You cannot withdraw it to hoard it. Physical cash will be banned. Those are the kind of things, and that's why I think it's a negative sum game. You're going to have runaway inflation. You're going to have social unrest, because the structure created by central banks is not a tenable situation, and you could see it now breaking down around the world.
Excellent points, Michael. In the time we have left, given all that, how does the average investor protect themselves here?
Well, I created a inflation deflation portfolio. So, right now, today, we're net short the market using inverse ETFs. We don't use any leverage or any margin. The model portfolio has been short emerging markets. We've been long the dollar right now, because vis-a-vis other currencies, we have the growth here in the United States, as well as interest rate differentials. So there's no stop clocks here. I do think gold is going to have its day, but we've been underweight gold in the model portfolio because gold doesn't like rising real interest rates. But you see, there's a few schools of thought here. There's the buy and hold, dollar cost averaging, everything's going to be fine. School of thought, the balanced portfolio, stocks and bonds. Well, those theories work well when both aren't in epic bubbles, but they are. So the market's going to collapse. It's going to bring down stocks and bonds, I believe, when that happens. But you have to be in a model that lets you know when it's time to get out and when it's time to protect and profit from what I believe is the third massive and the worst decline in stock prices since the year 2000. So the Nasdaq lost 85%, but the S&P lost about half of its value in 2000. It did that again in 2008. I think this third round is going to be much worse because, as I said before, there's not much central banks and governments can do right away to turn the runaway deflation into inflation. But I do think they're going to be successful in the midterm, and that's why I think gold, during the right time, is going to have a rally such as we've never before seen.
Excellent, Michael. Well, thank you so much for your views and your time today. Please direct our listeners where they can follow you more closely and find out about your portfolio fund.
Well, I have a website. It's pentoport.com. You also email me directly at mpento@pentoport.com, or you can call the office here at 732-772-9500.
All right. Well, Michael, thank you so much for your time today.
Thank you, Chris.